I think the chances are this era could be something like potentially the multipolar era, signifying the conflict between China and the US for global dominance. Now, we've historically really completely avoided the sector. I mean, our only meaningful resource position in the last 27 years was Tungela coal that we owned from 2021 to 2023. During the year, as the AI trend kind of emerged and accelerated, what happened is all the global tech companies figured out we will get massive productivity gains from AI. So we're going to significantly up the capex that we spend to try to capture these benefits.
Certain tasks that used to take them 3 months are now taking 3 hours, which is absolutely mind-boggling. It represents so much more in terms of what we're going to see in the future. I was in China in December, and concepts like augmented reality glasses, drone deliveries of your food, humanoid robots that are going to be in your factories and potentially in your homes in future, and then autonomous vehicles.
In this next session, we lift our gaze beyond South Africa to the global forces shaping economies, markets, and investment opportunities worldwide. Technology is moving at speed. AI is redefining industries. Entire business models are being rewritten. This session is hosted by Jacques Conradi, our CEO, and Justin Cousins, one of our senior portfolio managers. For those of you who don't know, Jacques and Justin are resident AI obsessives. My personal experience of this is that if you engage with them on the topic, you quickly realize how little you understand of this technology, but you are also guaranteed to walk away smarter and inspired to learn more. So please welcome Jacques and Justin to the stage.
So as we stand here at the start of 2026, I believe we are entering a new era. We're really at the dawn of a new age. I think the period that I grew up in, from the post-Cold War era starting in 1989 and 1990 till now, this 35 era, I believe, is over. And I think the world will look very different over the next 5 or 10 years. At the start of a new era, you never know what that era will be called later on. They also didn't for the previous eras. So I think the chances are this era could be something like potentially the multipolar era, signifying the conflict between China and the US for global dominance. It could also be called the AI era, because I think AI will be basically the trend that defines our lifetimes. I mean, there's also negative scenarios where it could be the era of conflict, which we hope not. And I think that the best case scenario would be the era of AI abundance if we navigate this AI transition era smoothly. Thank you, everyone, for being here. I think it was a fantastic morning of presentations from France and Helen. And what we want to do in the next 2 slots is give you guys some insight into, firstly, our performance from last year, but then more specifically, what the key themes are driving the portfolio right now. And I think we'll break it down into 3 major themes. First being AI, which Justin and I will cover. All of you will be hopefully using ChatGPT, Gemini, and Anthropic. And we really want to show you the areas where we think the improvement is most rapid and that's most going to change the world over the next few years. After that, in our panel discussion, we'll spend some time discussing our store of value thesis that's very much linked to the geopolitical conflict building between the US and China and what that'll entail for markets. And then finally, our view on the SA recovery story. That's largely driven by this massive potential commodities bull run we could see due to the store of value trade. And David's going to cover that with Rudy Dix. And hopefully that links up with some of the political discussion we had earlier this morning. So if I go on to our fund performance for the year, if I look at the high growth fund, we had a reasonable year at 14.7%. I think the key thing to think about if we compare ourselves with the multi-asset high equity funds is it's been a year where the resources sector did 140%. Now, we've historically really completely avoided the sector. I mean, our only meaningful resource position in the last 27 years was Tungela coal that we owned from 2021 to 2023. There was a very specific opportunity around unbundling and then the Russia-Ukraine conflict. So as the year progressed last year, we did take some exposure, but we had much less than competing funds or the index. I'll cover more of it later on when we look at what worked and what didn't. I think what's pleasing for us is that the 3-year, 5-year, 10 and 15-year numbers is really in the range that we want to deliver. And very pleasingly, the high growth fund hit the milestone of 200 times money since inception last year, meaning 1 million rand invested day one is worth 200 million rand right now. And we're certainly not ready to stop. If we move on to the pure hedge fund, I think also a reasonable year at 10.6%. What we really want to try to do every year is deliver double-digit returns without ever taking the chance of having a negative year. So give investors great confidence that we're consistently going to compound their wealth above inflation without having them to stress through material drawdowns. You'll see again in a year like last year where the resources drove performance, the fund lagged funds that had more resource exposure. And then finally, I think very pleasingly, Pure Hedge also hit the 100 times milestone last year. So both our flagship funds have done 100 times money since inception, something we're very proud of. So let's look at the good and the not so good of last year. Firstly, the good. I think we managed well through the volatile period, specifically April when Trump introduced the tariffs. We saw early the threat it posed to the market, put nice protection in place, and as markets fell, actually sold some of that protection and went long. So I think that period we really ticked the box of protecting the downside and trying to capture some of the upside. Additionally, we had no major losers for the year. I mean, every year is made up of your material winners, reasonable winners, and then losers. And if you can keep the losers small in size and few in number, that obviously does half the job of delivering a good year. And I think we did a reasonable job at that. Now the not so good. I mean, our job really is to try to protect the downside, but deliver 15 to 20% kind of returns in the high growth fund is what we aim for. And in a year like last year where the markets are strong, we certainly would have liked to be closer to 20 than to 15. So what are the two key areas where we missed opportunities? And each of these has probably a few percent in them that we'd hopefully do better next time. So firstly, during the year, as the AI trend kind of emerged and accelerated, what happened is all the global tech companies figured out we will get massive productivity gains from AI. So we're going to significantly up the capex that we spend to try to capture these benefits. Now, what that does is for companies like Meta, Microsoft, Amazon, is it pressures your short-term free cash flow, but obviously delivers great benefits in the long run. But in the short term, the market cares about the pressure and the cash flow. And where does that money go? That money goes to all the semiconductor companies, TSMC, NVIDIA, the memory makers, the hard drive makers. So we saw this trend emerging early in the year, but it was a new sector for us that we just started covering. We took an exposure in TSMC, that's the maker of all the semiconductors to go into NVIDIA and AMD and all the GPUs. Ended up being a fantastic opportunity for the funds and a great performer for last year. However, we always try to balance how quickly you move into new areas versus sticking to your knitting. And as a business, it's important to continue to grow your circle of competence, and the speed you do that involves some judgment. And I think the mistake we made is not moving faster, seeing how significant this trend will be, and more quickly switching our exposure from the global tech companies into the semiconductor companies. And I think the story around the store of value trade is very, very similar. We really haven't had any gold mining exposure in the fund for the entire 25 years. As the year progressed last year, we saw the Trump White House was going to change the world. The US would become much more nationalist, insular focused. They were withdrawing from all these UN bodies. And I think that clearly signified the world was changing. People would look for neutral, safe assets to protect them in geopolitical uncertainty, and gold is the one. So fortunately, I'm pleased that we figured this out. We didn't stick with our view that we'd never own this, because clearly the world was changing, and we thought this was the best geopolitical hedge for the portfolio. But again, had we just moved slightly earlier and slightly bigger size, it would have made a meaningful difference to the fund. So those really are the two things that I'd like to do better next time around if we get this kind of opportunity. So let's now move on to AI. What I want to do is Justin's going to present on some of the key things we see happening around the AI space. But I thought the best thing to do is to try to demonstrate to you guys really where we think the AI progress has been most rapid. And that's been on the coding front. How software development has improved, and specifically now having AI agents around. So doing a live demo is always a bit risky, but I'm going to try it to try to show you guys what's possible. So I've been using a site called Replit to develop things. At the back end, Replit uses Anthropic or OpenAI or ChatGPT that all of you guys use, but it just makes it so much easier to develop stuff. So my wife's here, and I've been trying to train our kids in AI. They're like 10, 8, and 6 now, and we've been developing apps over the weekend. So I'll give you one that we tried to develop a while back. So let's say my kids loves maze games. Let's develop a maze game where you control one of the minions, one of the other favorite movies, and you want to find a banana at the center of the maze. It should start easy, with every level getting harder. Make a nice minion themed celebration at the end of every level. Okay, perfect. So that's literally all you need to develop a program these days. Okay, let's get this one going. For another example, I'll give you another one I've done with the kids. For those of you that's passionate about education, it's really amazing now for developing educational tools. So let's say I want a website that will help my kids learn basic computation, make a site that allows me to select the 4 basic operations as well as a number range. The user should enter the answer and it should autocomplete. Have been entered. Okay, let's try this. And then finally, we're going to go for something a bit more extravagant to just show you what is going to be possible in this world. So I think those other ones seem like fairly simple projects. I think that they will still take a few developers several days or even a week to do, and we'll see how long they'll do it. I think it'll take 5 or 10 minutes to get to the answer. This one, I'm going to go slightly more extreme to say, let's do a mock-up of a financial advisor practice management app that runs on mobile. The app should have a client list. What else should it have? Let's say it should show the breakdown of client portfolios, as well as their life and disability cover. It should remind me of birthdays, have client contact details, as well as a meeting recording feature that will summarize my client meetings and give me key action points. Okay, so this is pretty wild. This would take like a whole team, like months to develop. So I'm going to leave it there. You'll see here now. It started running. I mean, this has been 2 minutes. It's already made the minions that's going to kind of be the characters you control. This one's also going. So it will actually show you how it goes while it's going. So as they run, it's going to be a few minutes. I'm going to hand over to Justin to take you through the presentation.
Good afternoon, everybody. I think Alan says he learns so much from us on a daily basis with respect to AI. I feel, there's this imposter syndrome that's sort of deep inside me. And every single day, I'm sort of attacking the AI with different questions. I'm getting more and more answers that I just didn't think of myself. So I feel as uninformed as Alan every single day. And I think it's amazing. We feel like, young 19-year-olds back at the office learning every single day. So it's an incredible technology, and I hope we can unpack it in a little bit more detail than what we think it is. So if we go back to, the question of what is artificial intelligence, fairly rudimentary at this point. I think most of us are familiar, as Jock said, with Gemini and ChatGPT. There's a whole host of other foundation models that are now becoming available for us to use as these chatbots. So it's becoming more ubiquitous. But what we want to try and demonstrate to you today is that it is just so much more than the chatbots. So if we move to the next slide, I think this is a representation of where the general public thinks we are today. Effectively, I think everybody thinks we are on a linear progression toward this intelligence. And, at the top it says, well, that's fantastic. This thing can create funny dog pictures for us to sort of play around with. But the reality is just so much different. We see this exponential change in intelligence. And I think the little guy on the right-hand side sort of sums it all up. Like when we look at these things internally and see the capacity and the capabilities of these bots, we are absolutely blown away. And I think Jacques' demonstrations are hopefully going to put that same sense of awe into all of your pockets. So as I mentioned at the beginning, so much more than answer engines. What is artificial intelligence and what can it potentially be in future? I think the first thing to call out is potentially the last point, the agentic software engineers. And as Jacques has mentioned, I think, for the last couple of years, as these chatbots have pervaded, we've actually seen a lot of skepticism out there in the market as to what these things are and what they're capable of doing. But something changed fundamentally in about December last year. And when I speak to my mates in the software engineering or software development realm, they're telling me, similar to what Jacques said to you, certain tasks that used to take them 3 months are now taking 3 hours, which is absolutely mind-boggling. So I think having agentic software engineers is something that we already see today. But it represents so much more in terms of what we're going to see in the future. I was in China in December, and concepts like augmented reality glasses, drone deliveries of your food, humanoid robots that are going to be in your factories and potentially in your homes in future, and then autonomous vehicles. We traveled in the Pony.ai autonomous vehicle in Shenzhen, and it was absolutely mind-blowing once more. So AI is powering all of these real-world applications, and this is the world that we ultimately are going to in the next couple of years. Perhaps not on the AV side in South Africa with all the taxis, but time will tell. What we found about, looking at the intelligence, this slide effectively shows the representation of a human brain. And as most of you will know, on the left-hand side, it controls logic and reason, where on the right-hand side of the brain, it's typically creativity and more EQ-related things that us men are typically not very good at. So the AI, in terms of where it's going, is representing more of a man's brain, I'd say, where you're seeing this jagged evolution. But the best advances that we're seeing today are in areas like coding, like mathematics, and scientific discovery. On the more creative side, you are seeing more hallucinations. It's not picking up social nuance and things like that. And those things will take time. And I think that's probably where you're a little bit sort of safer from a job perspective, which leads us on to the next concept. What becomes of today's jobs? The reality is we don't know, but there's some lessons from history that we can go to try and sort of ascertain where we're going to go to in the future. And I think the first and most important one is in the bottom right-hand side of the slide, where you see an example of agriculture. So in 1800, 80% of people in the world worked in agriculture. By the current year, I think that number is down to 2%. So humans have always found a way, they've always adapted. And just because you've lost all of these agriculture jobs, it doesn't mean that there are humans just sitting idly by doing nothing. And I think the same applies to, on the right-hand side, computers, who were people who physically sat there doing calculations on a daily basis. They've been replaced by actual computers. There's the switchboard operators for telephones and horse-drawn carriages, which we obviously don't use today, none of which have resulted in the end of the world. If anything, we're living much better lives today than we did in the past. So from our perspective, we see supercharged productivity growth and increased output across the economy as a result of AI adoption. And I think from a company's perspective, it's going to come down to a choice of doing more with what you have or cutting costs for functions in your business that are no longer required. On the recent Meta earnings call, they spoke very clearly about their choice, which was the former, which is doing more with what they have. They're not going to be letting go of their staff. They're just going to choose to accelerate their own development, which I think is important. But uncertainty remains. The speed of change that we're seeing at the moment is absolutely rapid. The example that I gave you with respect to farming took place over 200 years. I think this is impacting more sectors of the economy more quickly. And it is sort of, we do have cause to pause and think about the implications of this going forward. Jobs will be replaced by AI across many different sectors. But will we have the emergence of new jobs? We certainly think that you will. We just can't think about what they are today. Will regulatory bottlenecks stand in the way of adoption of these AI technologies? And then how do we respond to it as a society? Do you ultimately end up in a situation where you have higher corporate income taxes and a universal high income, which is similar to a social grant, but for everybody? We don't know, but these are things to ponder about. So there are a few areas where I think we've got higher confidence in the specific outcomes. I've mentioned persistent software development. As Jacques is demonstrating to you, we're going to see many more games being developed. We're going to see a hell of a lot more entertainment content and many more tools from a software perspective. So that is absolutely very, very exciting. We also anticipate you're going to see many medical breakthroughs. The question of whether those breakthroughs get through regulatory hurdles is one of those such examples I mentioned earlier on the regulatory front. But the actual discoveries themselves, I think, are going to come pretty quick over the next couple of years. We think there will be significantly higher economic growth. There are going to be new business models developed that we haven't thought of, and that is super exciting. And then finally, deflation due to the abundance of goods and services in the economy. This chart that I've provided on the right-hand side is very interesting because if you look at all the categories of inflation that we see, the ones in red have grown by a rate that is higher than the average, and the ones in blue have grown by a rate that are lower than the average inflation rate in the economy for consumers. And the common thread you'll see across this, if you want to try and thread it together, is to say, well, to what extent is government involved in all of those activities on the top half of the chart? The answer is a lot. There's so many regulations that are out there potentially impacting the actual inflation rate that we're seeing in those sectors. I suppose the hope is that with the proliferation of AI, you should see substantially more progress in each and every one of those specific government-controlled services, which should result in sort of more moderate price increases going forward. So I think that's where we are in terms of the high-level takeaways. But where do we, as Peregrine Capital, see opportunity at this point in time? So I think, as Jacques mentioned earlier, we've sort of split the opportunity set into three categories at this point in time. One being the application layer, the next being the infrastructure layer, and finally at the silicon layer, where we have been a little bit slow to the party. But that's where all the action is taking place at this point in time. The massive increase in compute demand is taking place because of what is being created at the application layer by these model companies. That is necessitating a massive build out of infrastructure, which is largely centered on these big hyperscalers that we do have exposure to. And where's that money going? Well, the money, to a large extent, is going into that silicon layer, where TSMC is our newest and biggest position. So with respect to this CapEx build-out, this is the biggest infrastructure build-out we've seen in the history of humanity. It's absolutely enormous. And if you look at next year's number of $734 billion between 7 companies in the United States, that represents a 62% compound annual growth rate over the last 3 years. And it is 12 times the size of what the whole of South Africa will spend in the coming year on infrastructure development across government and the private sector. So it is absolutely enormous. Another example of this is just, the US versus China, just to give you an idea as to the scale of what's happening in the US right now. The US is going to spend between 4 companies, approximately 11 times what you're seeing happening in China with equivalent businesses in that part of the world. China is obviously constrained by the access to chips because of US import restrictions. And you're seeing many more of the model breakthroughs take place in the US, but the Chinese are developing amazing open source tools to allow their technology to proliferate across society, which is quite incredible considering the constraints that they're facing. The question we get a lot is, are these companies making a return on their investment in this capital build-out that we've explained to you? And the answer is quite simply yes. And this chart over here, if we cast our eye to the right-hand side, we estimate that 76 billion of annual revenue run rate has been added in the last 12 months. If we take the quarterly numbers that have been added by all of the hyperscalers and effectively annualize those numbers, we're getting to $76 billion of ARR. That compares to the capex that's been spent over an equivalent prior period of approximately $240 billion. So assuming similar unit economics, the revenue is certainly coming, and we do anticipate that the profitability for the hyperscalers will be fairly similar going forward.
are these companies overspending? Are they going to blow their balance sheets up? Our estimate is no. And I think the main bottleneck that we've identified at this point in time is TSMC, which Jacques spoke about earlier. So from TSMC's perspective, they are a monopoly manufacturer of all leading-edge silicon across the world. So what does that mean? It means that if you are NVIDIA, if you are AMD, if you're Meta, if you're Microsoft, if you are any of these companies that want to build your own chip, you have to have that fabricated at a TSMC plant. So they are the bottleneck. And what this chart represents is the rate of growth in capital expenditure of the four hyperscalers in the United States versus what TSMC itself has done in terms of the rate of growth of their own capex. And I think you can see that the cumulative effect of this is that 2.1 times more capex is effectively going into the United States than is going into TSMC. But they all want to use TSMC to go and buy additional chips. So we do think there's a very, very clear bottleneck. And in 27, 28, 29, you're going to see this impact where TSMC has not spent enough. And the hyperscalers, even if they wanted to spend more, they couldn't. So the likelihood of them blowing their balance sheets up is fairly low. And what about valuations? Everybody runs around and tells us this looks like 2000. This is a bubble. How should we position our portfolio? Should we be concerned? And I think if you cast our eye again to the right-hand side, we compare here the NASDAQ forward price earnings multiple in 2026 today to what it was in the year 2000 at the height of the dot-com bubble that we all analogize and compare to. And what's interesting here is that the NASDAQ in 2000 was 2.4 times more expensive on a relative basis compared to the NASDAQ today. It was trading at a 60 PE. Today we're at roughly 24 times. So net, I think there's profit, there's cash flow, there's underpin from a valuation perspective. And many of the businesses that we are invested in have got extremely reasonable multiples. And we're actually very excited about their growth prospects over the next couple of years because of the AI, or despite the AI CapEx spend. So to sum up, what have we learned? This is the biggest build out of infrastructure that we've ever seen in the history of the world. The companies that are spending this are generating a return on that capital at this point. There is a rate limiter here. There's a bottleneck being TSMC that is going to stop them from overspending excessively. And that the valuations are reasonable. So we remain very excited about the prospects for the next couple of years. And now back over to Jacques to show you the capabilities of what can be created.
Okay, let's see if these things work. I mean, what we're trying here is basically, we call it one-shotting an app. So you give it an idea and it does it the first time. Obviously, what you can do is you can keep just adding features or telling it to change things. It's like a person. You can just talk to it. So you'll see it worked for 5 minutes to make this app. So let's go Bello, start the game and see how it works. Okay, there's our little minion we're controlling. It's a little bit small to my liking, but okay. Level 1 complete. And as you see, exactly what I asked for. Let's give us a more complicated maze every time around. My kids love this. We spent time developing several different games. Okay, I'm not going to go further than this to maybe not embarrass myself and find one I can't solve. So let's stop after level 3. So let's check the math game. Let me just show you, it's just literally amazing. You can just click publish now and it goes through the next steps. And literally within 2 clicks, you'll have this on a website that you can send to friends or family. It's just completely amazing that within a few minutes, you can just make your own app or game. So let's go Math Master. Okay, let's see how this looked. So let's pick multiply and let's just make it a bit easier, 15 times. Start game. So that's 72, I guess. 4. So it just, this one I've actually done at home. I've got an app or a website that I've shared to friends and family. I think it's an amazing thing to just quickly teach your kids something. So let's just get one wrong and see what it does. Okay, try again. Perfect. So again, works perfectly. And let's see how the advisor app looks. So it says, good afternoon, your practice overview. This is your total AUM. Okay, it only made 5 clients and 10 active policies. So let's check. So it's showing upcoming meetings here. Let's check that James van der Merwe. So it shows you he's a software engineer, age 40, birthday in 26 days, phone number, email. It shows you the size of the portfolio with a split. I guess you can tell it to just split it by fund, for example, to say, try to link up and split it by fund. This client's got a Discovery Life policy of 5 million Rand. I don't know if the premium is approximately right for what 5 million of life cover would be. You guys would know. Shows a recent meeting. Let's check the recent meeting out. So yeah, it shows the meeting notes, what you discussed, summary of the meeting, and the action points to do afterwards. So I just think something like this is absolutely incredible. Now, this is a mock-up of the app. I think we're probably about 12 or 18 months away where you're going to be able to do this for something in a business and properly. I mean, this isn't obviously linked up to the providers. You would need to use APIs. But the fact that it can do this, and like, let's see how long it worked here. Worked for 14 minutes. So it's 14 minutes that it would just run on its own. I think we're 12 months away where this thing can run overnight. It can link with the APIs and build you an app for any kind of business to help it easier, make it easier. I think it's just unbelievable that we're living in an era like this. For example, here, this app is now launched. It's literally on a website, and you can share that website with anyone, and they can use the app. So I just think it's completely mind-blowing what's going on here. And I think the key thing for us is, if you look at the rate of AI progress, it's already been fantastic. But what determines the rate of AI progress? It's really the compute Justin mentioned and how far the AI labs can write code to improve the quality of the models. And obviously the one part, the code writing, they've now basically automated to some extent, where your developers are 3 or 5 or 10 times more efficient. So I'd predict over the next year or two, the rate of progress is just going to go completely off the charts because the AI is basically self-improving to an extent now with the teams in the labs. Okay, awesome. That's it for the demo.